Good evening. This is Doc Severson for the TheoTrade report for Tuesday, October 24th. As we get further into the Q3 earnings season, we're seeing the shell game continue to play out. And it's really a case of the haves versus the have-nots. As we can see, the Dow just went absolutely ballistic today, up another 0.7%. And really the winners today were Caterpillar, up over 4.5%, and 3M, up about 6%. But those came at the expense of a couple of winners from last week, which is IBM and Johnson & Johnson, which were huge winners late last week. So we continue just playing this shell game with capital underneath the shell being moved around from one place to another. And ultimately, as long as the former winners at least hold the line, at least tread water, then as long as we get these big cap-weighted moves of 4%, 5%, and 6%, we're going to continue to see the markets go higher. But as we all know, what goes up can come down, and can come down just as fast, if not faster. We'll get to that in just a minute. Now, the Dow chart itself is just crazy town. This is the most linear, extended move that I have ever seen, certainly over the last 20 years. But this is the most extreme move I think that we are ever going to see on an index chart, with all three charts deeply into exhaustion. And we're seeing this very characteristic strong off the bottom. So if we go from last year's election, strong off the bottom, into kind of a thick period in the middle, and then we go into what I call the parabolic tail. This is absolutely classic. This is the way that every longer-term rally goes. Because what happens is the initial move is driven through short covering and is explosive up to the point where it just goes into exhaustion. So what happens at this point is the longer time frames, also in exhaustion, require a little bit more consolidation that occurs in this area, right? So this is always what happens in the middle of these things. And then once the energy is built up again at the larger time frames, and then, as a matter of fact, all time frames, then we start to see this energy just blistering out of here. Now, the X factor here is that through almost all of this year, we've had an exhaustion figure on the monthly chart. It just doesn't care, though, right now. So all the action is being really defined by the weekly and the daily charts, and this pretty much goes across the board for just about every index. So yeah, we're getting some good earnings, but really this is mostly due to the monetary policy that's been in place for the last several years, where you've got essentially cheap interest rates that are out there, and it makes no sense. It's opportunity cost to keep the money in anywhere else right now but into the market, with dividend payments as well as actual alpha that you can capture. Now, the problem with this move is it's just not broad-based. I mean, if we look at the Russell here, it's just not broad-based. So the small caps have gotten no love ever since they've been rotated into as of early October. So they're just holding in place right now. Again, the shell game continues. I contend that the next potential target for rotation would be big cap tech, if the earnings this week work out. So we have a couple of big earnings coming up, such as Amazon and Google setting up on Thursday. So that's going to be enormous after the market, Amazon and Google on Thursday. Now, why would I say the Nasdaq? Well, because of the amount of energy here that we have. We have huge amount of weekly energy, and we've already built up the daily energy as well too, because what we've seen over the past 3 months has basically been, after the big cap techs drove the market into the spring, we've seen pretty much a summer of consolidation. So they're ready to go again. Now, that could go in either way, though. So if we have big cap tech disappoints those earnings, that amount of energy could also move to the downside. So just to give some perspective on some of the earnings moves that we've had, here's the Caterpillar from last night. So after the market yesterday, we had Caterpillar absolutely take off and pretty much hold the gains all day long. And so also we had 3M. So 3M came along, and this one was this morning. So 3M took off this morning and pretty much held those gains, built on those gains and held them all day. So those were the good news stories. Some of the not so good news stories were like AT&T. It just reported AT&T is currently getting beat up in the aftermarket on their earnings. We also had Chipotle Mexican Grill, and that one got grilled as of yesterday. So reported aftermarket yesterday and went from $324 all the way down to about the $300 mark. So just drilled today. So that was CMG. And we also had today was Advanced Micro Devices. And this one just announced and initially was really strong, but is struggling to hold those gains right now. So across the board, we're seeing mixed results no matter where we look. So let's look at Caterpillar for a minute. So Caterpillar announced earnings over the last day or so, and now is also in that condition where we have an extraordinarily strong move here that has gone completely parabolic. We now have all three time frames in exhaustion, and not just in exhaustion. This is like beyond. This has crossed the line of death down here at 25. Typically when I see the linearity on a chart hitting down to 25, that trend is over. Okay, so would it make sense to do something with a bearish tilt to it? Yeah, perhaps. At this point, I think the probabilities favor at least the price going into a sideways to slightly down consolidation. I don't expect to see it just outright reverse up here, but maybe even a consolidation or setting up in the next flag. I mean, we've seen this type of move before where it goes kind of parabolic, and usually at this point it builds out a pretty healthy consolidation pattern. So this might be what we expect. How can we play something like that? Well, there's a couple of ways that we can do this, and all of these involve defined risk, which is the way that we like to trade them. So what we do not like to do is just outright go short on something. I think this is kind of the natural tendency for most people in this market. When they see something going crazy like this, they want to step right in front of that freight train and short it. Don't think that's the way to do it here, especially with a market this strong. But if you see an edge that you can fade, certainly we can do some defined risk trades. Now, one of them is the obvious choice for something like this, which is called the in-out spread. So it's a vertical spread placed at the money and is a very neutral type of trade. So in other words, when we set it up, really the way it's set up helps erase the effects of some of the Greeks that we don't want, which is like theta. We want to have enough time for the trade to actually start to make that move to the downside. So if you go over here to the Analyze tab, if we set that up, if we're playing this trade just at the money, we could set up what's called an in-out spread. So what you'll notice with this is that basically the amount that we're looking to gain is about the same as what we're risking on the trade. So we have about a 1-to-1. In fact, this is even a little bit less than 1-to-1, which is good. Reward to risk. Well, actually, the reward to risk is over 1. So we're paying 45 cents on a $1 wide spread. So that's a little bit better than a 1-to-1. Okay, and as you can see, the price doesn't really have to do anything. It could actually just stay in one area and stay within the expected move, and at some point it's going to be at our profit target, very likely for that period. Now, could the price rally from here? Absolutely. The price can do whatever it wants to do. However, the probabilities are such that it is unlikely to do that. It's unlikely to just continue going. A lot of that good news is already priced into there based on the fact that most of today's candle is somewhat red, so it already got faded into. So that's a good choice for something like this, would be just a simple in-out spread. So long option in the money, short option slightly out of the money. The next thing that we could do is actually an expected move trade. So if we look at this, and all of these trades we're just setting up for the next 24 calendar days for the November option cycle, so 17 November. If I look over here at 17 November, I'm going to see that we have an expected move from today until that point of about plus minus 6 points for the expected move. So if we're looking over here at the analyzer again, we have an expected move of about between now and November from 138 up to about maybe 144 or so, and then 138 maybe all the way down to 132 or so. So there's a 68% chance that the price is going to stay within this area between now and November expiration. So if we think that there's actually a higher probability that it's going to go slightly down versus actually going up, then we can use what's called the expected move vertical spread. So if the current price is 138 and change, and then we subtract 6 points from that, the target would be somewhere around 132. So we can set up a trade which is at 131, 132, and that is going to look like this. So it's going to be an out-of-the-money trade. Now notice that we're only paying 14 bucks per contract on this trade. Number one, so it's inexpensive, which is good. However, the price has got to move for us to get our profit. Now what you'll also see is there's a much easier way for us to be able to get about 100% return on this trade. So for us to get 100% return on the previous trade, pretty much have to ride that thing into the ground to expiration. In this trade, it's got a higher reward to risk, however, a lower probability. So those two are always canceling each other out, right? There's no perfect trade in options, only one that fits the requirements of what you're seeing. So this one is a better candidate if you're expecting a larger move. Probably not expecting a larger move to the downside in this trade. I'm more expecting to see a sideways consolidation at this point to work off this massive move. Typically, we don't see things go up and then straight back down again. It can happen, but what I'd more likely see is setting up another flag up in this area. So that brings the third possibility that we can set up, which is going to be a ratio butterfly. Now, a ratio butterfly looks like this. And a lot of you will say, hey, that's the same thing as a broken wing butterfly. Well, it ends up being synthetically exactly the same thing because you get a credit for putting the trade on. And there's also an area up here, which is sort of false advertising, if you will. You look at any butterfly like this is always somewhat false advertising because it's very difficult to get any of that profit until the last day or two, right? So it's very difficult to get that. So you're kind of lulled into, hey, I could get all these profits. Well, that's great as long as the price just hangs out there for the next 24 days. Now, we also are looking at a little bit more risk on this trade. However, there's a higher probability of us winning on here. So what's the probability of the price continuing higher from here, another 3 points higher to put us actually into a losing condition by expiration? Now, with all three of these trades, they're set up short deltas, so if this thing crashes from here, we don't have any problems for this. So here's three different applications that we can set up for something that's like Caterpillar, join the crazy train here, and perhaps is due for a fade, but not in an unlimited risk manner, such as with short stock. All right, folks, that is it for today's report. Thanks for listening. We'll see you tomorrow.